Stop Americans over 50. Your bank can quietly drain your money in 2025, and most people never realize it until it's too late. Today, I'm exposing the 5 hidden bank traps that cost seniors the most. These traps look small at first, but over time, they quietly take thousands of dollars from older Americans who work their whole lives to save what they have. Stay with me until the end, because trap number 5 is the one almost nobody sees coming. Banks don't need to call you, email you, or personally warn you before raising fees or changing account rules. They simply update their terms online or add tiny notes on statements that people rarely read. Legally, that's enough for them, and that's what makes these traps so dangerous. If you are retired, living on a fixed income, or relying on Social Security deposits, you are especially vulnerable to these hidden changes. One of the most common traps is the slow fee increase trick. Banks know that if they raise a fee by $10 all at once, customers will complain, so instead, they raise fees slowly over time. A checking account fee that used to be $10 becomes $12, then $14, then $15 or more. It happens gradually, month after month, until you are paying far more than you ever agreed to. Seniors often don't notice these small increases because the numbers appear tiny on the statement. But these small changes add up to real money over an entire year. It's not just checking account fees. ATM fees, paper statement fees, overdraft transfer fees, and minimum balance requirements all slowly rise. For example, an ATM fee that used to be $3 may now be $4.50 or even $5. And if you withdraw cash from an out-of-network ATM, the fee can be even higher. Paper statement fees, which used to be $1 or $2, are slowly rising to $3 or $5. If you still prefer mailed statements, this can become a yearly cost that you didn't expect. Even minimum balance requirements change. You may have opened an account years ago when the minimum balance was $100. Today, that same account may require $500 or even $1,000 to avoid monthly penalties. And most people only discover these changes after they have already been charged for falling below the new minimum. The slow fee increase trick works because banks are counting on you not noticing small changes. But just one fee increase of $2 per month becomes $24 a year. And when several fees increase at the same time, the cost can quietly grow into hundreds of dollars annually. Seniors can protect themselves by reviewing statements monthly and contacting the bank whenever fees increase without explanation. Another major trap is overdraft protection, which is often advertised as a helpful safety feature. In reality, overdraft protection can be one of the most expensive products a bank offers. If your account goes negative by even a few dollars, the bank can charge overdraft fees of $25, $30, or $35 per transaction. Some banks charge multiple times in the same day. That means if 3 small payments go through while your balance is low, you could face more than $100 in fees instantly. Overdraft protection itself also has built-in costs. Many banks charge transfer fees when money is moved from savings to checking. Some banks charge a monthly fee just to keep overdraft protection active, even if you never use it. Seniors face overdrafts more often because income may arrive later than expected. Medical bills can appear suddenly, and automatic payments may process earlier than usual. One overlooked detail is that overdraft charges happen automatically. You do not receive a warning beforehand. The transaction goes through, your balance goes negative, and the fee is instantly added. By the time you realize what happened, you may have multiple fees stacked on your account. Understanding your deposit timing, especially Social Security deposits, is key to avoiding these surprise charges. Another trap that drains money from older Americans is the minimum balance penalty. Many banks require you to keep a specific amount of money in your account to avoid monthly charges. This amount varies from bank to bank, but common thresholds are $500, $1,000, or $1,500. If your balance drops below that amount even once during the month, you may be charged a penalty of $5, $10, or $12. This penalty hits older Americans especially hard because balances often fluctuate. If you withdraw money for bills, medication, or unexpected expenses, your balance can easily fall below the required threshold. And once that happens, you receive a penalty at the end of the month, sometimes without any clear explanation. Many seniors don't realize that these minimum balance rules changed years after they opened the account. The account that once required no minimum balance now quietly demands $500. If you don't maintain that amount, you pay a fee. It's important to regularly review account terms and ask your bank for options that don't have minimum balance requirements. One of the most costly traps for people over 50 is hidden fees inside retirement accounts like 401(k)s and IRAs. These accounts often include expense ratios, custodian fees, and advisor management fees that most people never see. While these fees may appear tiny, such as 1% or even 0.5%, their long-term effect is enormous. For example, if an advisor charges 1 or 2% every year just to manage your account, that cost compounds over 10 or 20 years. That small percentage can reduce your retirement savings by tens of thousands of dollars. Many seniors are placed into high-fee funds without fully understanding the cost. These include target date funds or managed portfolios, which often carry additional layers of fees. Most people assume their advisor is actively monitoring their account. In reality, many advisors make very few adjustments while still charging the same high fee year after year. This is why it's important to ask questions, understand expense ratios, and look at lower-cost alternatives. Even reducing fees by 0.5% can keep thousands of dollars in your retirement savings over time. But the most dangerous trap for older Americans is the interest rate shock. If you miss just one credit card payment, even by accident or a single day, your interest rate can double overnight. A typical interest rate of 16% can suddenly jump to 29% or higher. This new penalty rate can remain on your account for months or even years, dramatically increasing the cost of carrying a balance. This trap affects seniors more than any other age group because medical emergencies, travel interruptions, or misplaced bills can easily result in a missed payment. And banks are not required to call you or warn you before raising your rate. The change happens automatically, and you often discover it only when your next statement arrives with a much larger minimum payment. Here's the most important thing you need to remember. Banks do not need to personally warn you before any of these traps activate. No phone call, no letter, no early alert. Most seniors only realize what happened after the money has already been taken, the penalty has been added, or the interest rate has already increased. If you're over 50 and want to protect your money in 2025, follow this channel for more financial warnings, banking risks, and money-saving insights. Stay informed, stay alert, and protect your money before it's too late.